You're watching episode 35 of the Tax Smart Daily, a daily video series for real estate investors to get tax smart.
Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release.
Thanks so much for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall. And before we get started, I invite you to join our Facebook group, Tax Smart Real Estate Investors. Link to that is in the description below. Also, check out our new premium newsletter, premium content site. That is taxsmartinvestors.com. Today's topic is all about short-term rentals. I'm currently at St. Augustine Beach. It's raining, so we've got a break from the sun, and I wanted to record a video for you real quick. So short-term rentals are a loophole. It allows you to take a tax loss from the rental activity without having to qualify as a real estate professional. Now, before we get into that, why is that even important? When I buy a new residential rental property, let's say I buy a beach home, I spend $1 million on it. I can get that beach home cost segregated, and I will probably be able to claim about $200,000 worth of depreciation. That depreciation is going to create a tax loss. Now, most rentals are by default passive, and that's section 469 of the tax code. And that default status means that the losses created from depreciation and any other rental expenses, those losses are passive losses. And passive losses can only offset passive income or gain on sale from a passive activity. On a short-term rental, I can create these large passive losses just like I could with like a multifamily home or a single family home if I cost segregate that. The cost segregation is just a tool to accelerate depreciation deductions, which then creates a large tax loss. But on short-term rentals, that tax loss, it's still passive, but I don't have to qualify as a real estate professional to make it non-passive. All I have to do is materially participate. And the reason for that is in the Treasury regulations to section 469, there's a little carve out. And it says that if your average rental period per customer for that rental property is 7 days or less, then you don't have a rental activity under section 469. And all that means is you don't have to qualify as a real estate professional and then materially participate in the rental property. You just have to materially participate in the rental property. Now, why is this important? Well, qualifying as a real estate professional is tough to do. To qualify as a real estate professional, you have to spend 750 hours and more time in real estate than anywhere else. So if you have a full-time job or even a part-time job, it's tough to qualify as a real estate professional. But with a short-term rental, you can have a full-time job, you can cost segregate it, get that $200,000 of bonus depreciation, and claim the rental loss that comes as a result of that, as long as you materially participate in the short-term rental. Now, in this example of a $200,000 tax or depreciation benefit, what is the tax benefit there? Well, I would take my marginal tax rate. I would also take my state tax rates. Most states allow you to do this. Some states do add back depreciation, so you have to be careful there. But in this example, I always guesstimate 30% whenever we're doing this for clients, like a back in the napkin, if we're not like doing some in-depth study for them or in-depth projection. So in this example, I buy $1 million beach home and I immediately get a $200,000 depreciation deduction, which yields $60,000 in tax savings. Now, if this is not a short-term rental, let's say this is a multifamily home, and let's say I'm not a real estate professional, I can do the same thing. $1 million purchase, get the cost segregation study done, but the depreciation, let's say it's still $200K. It creates a tax loss, but that tax loss is passive. And on long-term rentals, because they are rental activities under section 469 of the code, I first have to qualify as a real estate professional, and then I have to materially participate in the rental property. But with short-term rentals, because I don't have a rental activity, thanks to that 7 days or less carve out, most short-term rentals fall into that. Because I don't have a rental activity, I don't have to qualify as a real estate professional. I just have to materially participate in the rental property. Now, if you're a subscriber to our premium newsletter, the taxsmartinvestors.com, we just wrote an article about this. And it breaks it out. It also breaks out why short-term rentals should not generally be reported on Schedule C and where a lot of tax advisors make mistakes. You can get a 14-day trial to that website. So if you want to go read that article, just because it's relevant right here to this discussion. Go sign up for that 14-day trial. Again, that's taxsmartinvestors.com, and you'll be able to read that article, and you'll get the next two that come out over the next 2 weeks. Hope you enjoyed today's video of the Tax Smart Daily. Thanks so much for watching. Join us online in our various communities. Follow us everywhere. Links to all of that stuff is in the description of this video below.